Good morning, traders. Today is Saturday, July 8th. Well, interesting week, wasn't it? Shortened week, sorta, yeah. July 4th week. And as of Thursday night, it was actually bearish because of the down move that happened on Thursday, if you recall. It was a big down move, wasn't it? But having woken up Friday morning, I saw a different pattern emerge. It wasn't what I expected, actually. I think we're going to go down even more. But it didn't. And in fact, here's a tweet that I sent out yesterday to James Franklin. I think Thursday was the bottom. Per the 195-minute chart, Friday was going to go up. Well, we all know what happened. It double bottomed on Friday. It went up all right, and it went all the way back down, exactly where it started. But still, it went up. I'll talk a little bit more about that chart pattern a little bit later. So, this is what we're looking at, guys. Look at that wedge. Look at that wedge. Here's the last time we had the exact same wedge formation. When we hit 438.37. Right there. Kind of hard to see. But, where are you? Oh. Maybe I can't, I thought I could zoom into that. Magnify slow. Interesting. It's a different option. Okay, anyways. So, there you have it. Consolidate, consolidate, consolidate. Boom, up. Okay, so, let's zoom in and look where we are. I've talked about, this is like 2 weeks ago, guys. 44486. Maybe 3 weeks ago now. I can't remember. Whichever episode that was. 44486. I think it was 3 weeks ago now. What's going on, guys? Up, down, up, down, up. Uh-oh. So, okay. And once again, no, I don't subscribe whatsoever to a rising wedge being bearish. No. No, 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 no. That idea is overridden by if there's a consolidation under major bars, major lines, like channel lines, or major levels, or major bars, like these bull bars, or like the all-time high bar, if that's, you hit it, you broke it again, and you're still going up, that's not bearish, okay? So, I still hear from time to time, not constantly, not every day, time to time, somebody wants to throw out, oh, that looks like a bear flag. No! When you are making higher highs like this under a major channel or bar, or I'll just call that a bar of bull bars. Okay? That's bullish. Always bullish. Always, always, always. Always, 100% of the time it's bullish. Now, if it's not making higher highs, if it's kind of making a neutral horizontal wedge, kind of making lower highs but making higher lows, if it's making lower highs, that I can see as potentially bearish. Okay? I can see that. I can see that as bearish. But when it makes higher highs under a line, a major zone, oh no, that is not bearish. Of course, you can't see that, but that's exactly what happened in May. It was making higher highs, higher highs, higher highs. It was consolidating under that zone. You have to go back a couple episodes if you want to see what I'm talking about. I kind of got part of it right. I got the end part of it right here. See that? Boom. But it was consolidating higher highs, higher highs, higher highs. consolidating in this band, and then boom. Well, guess what? Higher highs, consolidation. It's about to do it. Okay? So, there you have it. Now, yesterday's move. Remember? Up, down. 100% round trip. Double bottom. 100%. 100% round trip. That looks similar to June 8th. Up, down, and then up. Okay? And before it went up, down, then up, guess what? Down, 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 down. From Thursday. Down, 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 down. Up, down. Whoop. Aha. Okay? So, there's that pattern for your consideration. There's the double bottom, 438.30, 438.30. Boom, boom. All right? So. Here's a low. Here's a high. Higher low. Higher high. Double bottom. Not lower low. Yeah, had that gone to 438.29 in the afternoon, late afternoon, oh yeah, we're having a different conversation now. Okay? So we need to watch out for what's going to happen come Monday, Tuesday. All right? And I made damn sure to watch extended hours. Oh, yes, I did. I've seen market maker be sneaky, sneaky, sneaky. Sneaky, sneaky. Slick Rick. Make a lower low in extended hours. Okay? It didn't do it. So let's just see what happens. All right? Okay, let's just kind of get on to principled tweets. Okay? Principled tweets. Okay, Kim. My point on tweeting this is, let's see, do I have it here? No. Okay, here's the point that I tweeted this, why I tweeted this. If you have to go back 40 years to find a pattern, like this, like Kay's doing here, 40 years to find a pattern, it means you don't know what you're looking for. I'm just going to be blunt. 40 years. Seriously. You don't know what you're looking for. That means you couldn't find the pattern you were looking for from after 1983. So it took you that long just to find that pattern. Okay? That means you don't know what you're looking for. And once again, I have tweeted this and I've said this in previous episodes. Do not go back to previous years as reference points. Like this, 1983, 2000, 2008, 1979, Paul Volcker, 1929. Don't do it. There is no relevance to doing that. No relevance at all. Because the financial underpinnings in any previous year is not comparable to 2023. The only year that is comparable, and I've said this in previous episodes is, and I've also tweeted this, 2019. That is the only year that has comparable financial underpinnings to that of 2023. And also, the October 13th low of this market goes back to 2019. Draw a line straight left from the October 13th low. And what year do you hit? 2019. Okay? So, see what I mean? This is why I'm just saying, like, man, you got a lot of people, so-called gurus out there, pushing stuff. Have to go back 40 years to look. No, really, you just need to go back. You didn't need to go back 40 years, okay? You just needed to go back 4. All of my analysis that I've done for this entire year has been based off of 2019, by the way. And so far, my analysis has been right. There you have it. Bada boom, bada bing. Oh, Game of Trade's finally getting on the MACD bandwagon. Look at this. Uh-huh. Oh, bullish cross coming. Uh-oh. Uh-oh. See? More and more people. Mike Jones also starting to reference the MACD. MACD or maybe RSI occasionally, but MACD for sure. Yeah. The MACD is so powerful. It is more informational than any oscillator. And that includes like RSI. RSI is good. I use RSI. Don't get me wrong, I use RSI. But the problem with oscillators is they just oscillate between an upper and lower zone, right? So they like if you're going to talk math, they represent data in the form of a percentage, right? Because anytime you oscillate between, like for example, the RSI, the low side is 20, the upper side is 70, right? You oscillate between those zones. That's essentially between 0 and 100%, right? So that's my problem with oscillators. Is it's expressed, the data is expressed essentially as a percent. The MACD expresses data in absolute terms, absolute relative terms. See what I mean? Look at that, like, whoa, it's going way down here. Oh, that's way up there. Oh, that's kind of in the middle. Aha. That's why the MACD is more powerful, in my opinion, than any other indicator out there. Because it doesn't oscillate between a 0 and 100%. And it doesn't express data as a form of a percent. That's like when you're playing video games, right? You're like, oh no, my power, my beast mode power is down to 60% left. Okay. But, okay. That just tells you, like, real time. That tells you real time. That's like me telling you, yeah, today's temperature right now at 2:52 p.m. is 82 degrees. Okay, fine. But that oscillator cannot tell you relative to where it has come from. Well, you can see that where it came from, but it can't give you an idea of where it could go. It just tells you at that very moment in time. This is the pulse, but it can't tell you where it could go. Okay, so there you have it. And of course, I've got to get my digs in. Ron Walker, old maverick of Wall Street, still talking trash crash. Still talking that trash crash. Still talking the trash crash. After all of this time, you're still talking the trash crash. Donations and membership fees don't buy guts or brains. You two are short on both. Okay, let's just kind of get into some intraday stuff. No, not intraday. This is just a summary of what happened during the week. Okay? So, this is July 3rd. That would have been that half day Monday right here. Scaled out of calls. I'm not going to get into every single tweet on that day or any day. Scaled out of calls. I got in at the low. I got in at the high. Got out at the high. That's it. Let's skip over to July 5th. This would have been, obviously the 4th we're not trading. This is the 5th. Boop, boop. I got out of this move right up here. 20% pop. Scaled out of calls. Okay? So, this is the 6th. Okay. This is the 6th. Scalping out of calls. 75% of my calls. This is right here. Okay? Obviously, I was watching this down move. I'm like, ooh. Because I don't know how low it's going to go. Right? Here's opening bell. It already fell. I was like, man, are you going to... See what I mean? I'm watching the down move. So, anyways. However, you're going to see, having seen this down move, though, while I did make 29.66 on the up move, what I'm doing next, though. Opened puts for tomorrow opening bell. Right here, this is equivalent to this. I got puts. I saw this down move, and I saw this reflexive up move. This is reflexive. Impulsive. You go, yeah, what? Impulsive, reflexive, same thing. Impulsive up, I knew. I was like, oh, this is going down tomorrow. It doesn't mean like I'm not saying, oh, it's gonna. It has lower to go because this was a completely reflexive up. No back test. Turns out this is the back test. That's why I got puts here. I'm like, oh no. You're going down tomorrow. It's going to go down. It's got a back test. Up. Where are you going to back test to? Where are you going to make the higher low at? That's basically why I got puts. Okay? That resulted in a 27.27% gain. I sold it at open. Got puts here. Woke up, opening bell, sold it. 27% gain. Okay? But then I turned around and got calls. 41.67% gain. Now, let's get into next. Why did I get calls? Why did I not get puts? Okay? Because it would have been very easy to get puts, having seen this economic data drop, right? I don't even remember what it was. Was it non-farm payrolls? I can't remember what it was on Friday. That just goes to show you, I don't care what it was. You see what I mean? I think you're gonna. Yeah, I think it's the next tweet. I don't care what the economic data was on Friday morning. I knew that there was one coming up. I knew that there was, but I don't care what it was. Why? Because it is a natural move. It's supposed to go down. It's not going to go this. Think about this. Big move down. It's not going to go big move down, big move up. No. It's going to go big move down, up, impulsively up, but then it's got to come down. It's got to stop the fall. It's not just going to go boom, boom, like a V. No. No. So, I almost didn't get, it was like, doop, doop. I was like, yeah, because it has to go down. You see what I mean? That's why I got puts. I'm like, I don't care what the data is. But for those, some of you may have thought, oh, but maybe tomorrow, maybe on Thursday night, some of you would have been, well, yeah, but maybe the economic data is going to cause it to go up. Well, it did go up, but it went down first because it has to complete the higher low here. See that? Down first and then up. It's not just going to go up, sideways, up even more. Okay, so, anyways, the 195 minute was the key. I don't have the 195 minute here, but this overnight pattern right here kept the 195 from dropping like a knife overnight. That's what changed my mind when I woke up to that and saw this pattern. I'm like, ooh, it's basically flat, because they weren't wanting to drop the 195 overnight. So when I got puts up here and it went down here, so it did go down, right? It did, obviously it did. I thought it was going to go down even more, like down here. I thought the 195 was going to drop it down to like here. Okay? So when it didn't drop that much, I was like, that's basically flat. That's what made me reassess. I'm like, ooh, this isn't going to fall. When I looked at the 195, I was like, uh-oh. Okay, here we go. Here's my soapbox. It cannot be more convincing. The evidence why you should never try to interpret economic data. Look, it dumped. Like, oh, see, but then it pumped. Dumped, up, down, up. See what I mean? That leaves you literally guessing like you're at the casino playing craps. If you continue to try to interpret the economic data, interpret it, you are no better than going to the casino and playing craps. Statistically, you are no better. You are no better. When instead, you need to be focusing on how the market maker is positioning itself, like in the discussion I just told you guys. My thoughts. Why did I get puts here? Why did I get calls here? Okay? You need to start thinking more like that. Stop thinking about, ooh, what if the data comes in hot, cold? Who cares? Who cares? The market maker was going to go down no matter what. This was just a head. Yeah, it's a head fake. It was a head fake. Okay? Boop, boop. When the destination was always here from starting up here. It always was here. It just wanted to go boop, boop, snag some of you guys, get to head fake you, and then go down. See? That's what I'm talking about. Just like the destination, obviously now hindsight is 2020, the double bottom here and here. That was always the destination. Okay? So that's all I've got for you guys this week. Feel free to follow me on Twitter, where I do give real-time tweets intraday. So feel free to follow me on the action on that. Don't forget to listen to your favorite music while you are trading. It helps you get into the right state of mind, the right flow state. Please give this video a like, share, subscribe, or click to be notified when I release something new. With that, I'm Agent 000, signing off.